Their families cannot access that cash, cannot access those assets. So they're going through what they call a probate here in the States. And I'm not going to go too much detail into it because I don't know much about it right now. Hey guys, welcome to my channel. My name is Donald, where we talk about marketing, personal finance, entrepreneurship, and a little bit of psychology and how that all ties together. But before we get into the video, I want you to smash that subscribe button, tap that notification bell, and I'll see you guys in the video. Welcome back, Course Hackers. Now, this is probably going to be the last episode in this series, and the title of this is Build Wealth. So now that we have gone through the previous 5 steps, our final step is to build wealth. And there's so much in this that we can only briefly touch upon each subject because everything that we're going to talk about literally deserves a podcast or its own 2-hour segment. So we're going to try to make this really quick and really brief. So if you want to know more, join our newsletter. That's the best way to learn about things. There are a couple ways to build wealth. Passive income streams, which is, for example, like real estate, or you're renting out rooms as an Airbnb. You're investing in the markets like mutual funds, 401ks, stocks, REITs. I don't even know how to pronounce those, but it's real estate investment trusts. And the last one is affiliate businesses. So for example, just making referrals to this app or making referrals to Airbnb, and they'll pay you for making referrals or something. Those are affiliate businesses. So those are some ideas that you can use to build wealth. And it's really slow and steady for me. I mean, I just started the Course Hack business and it's going to run as affiliates, but half my paycheck goes to my investments. That is my mutual funds. It's been like this for a good 3 years now. So as an aside, I'm going to link to this video and we're going to take a look at how my finances were for the last 3 years. But we're just going to blast through these slides for now. So next we're going to talk about inflation. And inflation is when, let's say, as time passes, then the money you have now is not going to be worth as much. Given $1 today, things will cost more in the future. So in 25 years, $1 today, if that could buy you a McDonald's cheeseburger, then in 25 years, for example, that same dollar can only buy you half a burger. So that's inflation. Things get more expensive. That's basically the layman's term, how I understand it. The average inflation rate is 2.8%. And if we take 72 divided by 2.8%, that gives us the year to double. So it takes 25.7 years to double. What that means is, to give you an example, in 25.7 years, $1 million house now would cost $2 million. That's what inflation is. Next thing, the tax of time. So that's the question you gotta ask. How much would things cost when I retire in 25.7 years? The cost that you're paying now is not gonna be the same in 25.7 years. It's gonna be double that. Losing money. If you had $100,000 and you lost 50%, how much do you need to gain to get back to 100,000? A lot of people think it's 50%, but in reality, it's 100%, because just think about it. If you had $100,000, you lost 50% of that. That means it's $50,000. If you want it to double to become 100,000, that's times 2. So you need it to be 100 or 100% increase in order to get it back to $100,000, because a 50% increase would only bring it back to 75,000. So to get it back to 100,000, you need a 100% increase. So really, I'm not going to go into details, but really consult a financial advisor that you trust to protect against this. And 6th step, taxes. And I'll be blunt, just always go for Roth IRAs or permanent life insurance, which we've been talking about through this entire series. So those are really the only two that you should really be putting your money into. 401k, I don't even invest in 401ks. Once I learned about Roth, I just moved all my money from my 401k to my Roth 401k. So different countries have different things. In Canada, we have the TFSA, but here it's 401k. But both Canada and the US have permanent life insurance, and people call it really the rich man's 401k. The sixth step, the taxes reason. So for both, you pay the taxes of today instead of tax of tomorrow, because in all likelihood, tax is going to rise, and you don't want to pay a higher tax. You just want to lock in the lower tax now, then pay the higher tax in the future. You have 100,000. If you tax that now and you put it in a Roth IRA, that means only 100,000 is taxed now. Earnings will not be taxed, and you pay today's rate, not the rate of tomorrow, not the future tax rate. On that 100,000, over 25 years, it grew to $2,500,000. You don't pay tax on it in the future because your initial 100,000 has already been taxed. So that's why I always say Roth IRA or permanent life insurance. If you had put in a 401k, then that $2.5 million will be taxed at the future rate, and that future rate could be higher. And the last step, which is the seventh step, which accumulates everything, is to protect your money, get your will, make a trust. So if you die, your assets will go to where you need to go. And to give you a little bit of a story, I believe both Aretha Franklin and Prince, they both had assets up into the tens of millions of dollars. But because they didn't have a will, they didn't have a trust, their families cannot access that cash, cannot access those assets. So they're going through what they call probate here in the States. And I'm not going to go too much detail into it because I don't know much about it right now. It pretty much means that that money is locked in a fight with the courts until they can figure out what to do with it, figure things out. And by the time that ends, probably a lot of money has been spent on going to attorney fees and court fees. And that's just something you don't want your family and loved ones to go through because you forgot to build a will or make a trust. So always think about making a will or getting a trust. And if you don't know how, consult a financial advisor that you trust. I can't emphasize how much that word means to me, that you trust, and protect against that. So with that said, that's the end of it. Thank you for watching this series and learning a little bit of personal finance with me in this time where things are both scary and exciting. And if you haven't already, please join our newsletter where you will get more tips and tricks and details, and we will go more in depth with all of these concepts so you could be better educated and make the right proper moves, because it's because people don't talk about money. And when we don't talk about things, how can we expect to learn about it? How can we expect to plan for it and strategize and succeed? And this is what all these videos are about. It's just about educating you so that you can make the right decisions, the correct decisions that you feel comfortable with, and succeed. So go ahead, go to the description below, click the link to join our newsletter, and don't forget to please rate, comment, subscribe, and we'll see you again in another series. Thanks for watching.